In this episode, you will be familiar with the employment rate and the impact of this index on the economy. Welcome to Got In Early, a podcast about investing in financial markets such as cryptocurrency, the forex market, and the stock market. Here is your host, Komer from Ados Capital, and don't forget that
Ados is with you to succeed in investing.
So what is employment rate? The employment rate is an important and significant factor for the economy at different levels of society. Employment indicators are used as an important component in calculating other economic indicators such as GDP. Employment means being busy with a job or an activity that creates benefits for the person doing it. What is the impact of employment rate on the economy? The employment rate in a society indicates the level of health and economic power of a country. When the employment rate increases, the income of the people in that society automatically expands. This is because people will have a higher purchasing power. It can be introduced to improve the welfare of the society. How to calculate the employment rate? Employment reports in the United States consist of two separate service models. First method. In this method, 400,000 economic enterprises and commercial institutions are sampled. The result of this statistical study is the list of employees and wage earners in the non-agricultural sector. It shows the figures of average weekly working hours and average hourly income of employees. The second one, more than 50,000 households participate in the random sampling and survey every month. This data examines the total hours worked and the number of employed. The unemployment rate cited in this statistics is delayed and does not have the ability to predict recession. Let's talk about governments and employment rate. Governments can change the employment rate of society by using monetary policies and financial instruments. Governments generally use expansionary and monetary policies to change inflation. They must first be defined in the term of how they are used. A contractionary policy is a policy in which government raises the interest rates to control inflation so that the cost of keeping money in the community increases. In general, more employment will be possible with the more inflation. However, when production does not increase, the unemployment rate automatically rises. At the end, by listening to this podcast, we at Ados Capital hope you have found the answer of the question, what is employment rate in the economy? Also, you can help our progress by sharing this episode, which is published in Ados Investment Magazine, and help to optimize this podcast by submitting your comments. Thank you. Have a good time.
Ados is with you to succeed in investing.